if you don't own any gold, you just made a big mistake. I mean, it's outperformed the S&P 500 with less volatility since the year 2000. So maybe you could say it's a fluke, year or two or 10 years, but a quarter of a century, gold has outperformed the S&P 500. That's that's astonishing. So you better get some, because with the writings on the wall, we have an insolvent nation which is incapable of controlling its inflation problem. Both those things are going to get much worse over the coming years and decades.
America's debt is now so massive that just paying the interest costs an extra $60 billion this year. And that's before we even talk about the bubbles building across stocks, credit, and real estate. The national debt is nearing $37 trillion, and in the first 10 months of fiscal year 2025, servicing that debt increased by 8% compared to the same period last year. Why? Because the debt is bigger than it was in 2024. July's deficit alone was $289 billion. That's $45 billion more than July last year, as spending once again grew faster than tax revenues. MichaelPento, president of Pento Portfolio Strategies, warns that unless a political leader is willing to trigger a short but severe depression, similar to the 1907 banking crisis, to purge excesses, this debt and bubble cycle will persist. He points out that today's equity market capitalization is more than double US GDP, a phenomenon rarely seen in history, and it's happening alongside massive credit and real estate bubbles. One radical idea has been floated in both the US and Belgium revaluing gold reserves. For America, that would mean marking up its 261.5 million troy ounces, the largest reserves in the world, from the statutory $42.22 per ounce to the current market price. Pento believes hard assets like gold will keep climbing in the years ahead because the US can't balance its budget, can't maintain favorable real interest rates, and relies on easy money to stop financial bubbles from bursting. He notes gold has beaten the S&P 500 with less volatility since 2000, and that's no coincidence. In his view, the US is already insolvent and inflation is out of control. Both problems are expected to worsen. That's why, he says, owning gold isn't optional, it's essential. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Unlimited number of cryptocurrencies and blockchains that can be created. But all I'm saying is that they don't belong, in my opinion, they don't belong in your retirement fund. And there really is there's nothing like gold. You cannot create gold. There's no more of it. It's more and more difficult to mine. It's virtually indestructible. And it's extremely beautiful. It's actually, it's malleable, it's ductile, you can make jewelry out of it, it's tangible, it's beautiful. And by the way, so is platinum. Platinum is actually more rare. It's rarer than gold, and it's actually more durable than gold. So that's another thing. I mean, hard assets are going to explode, I think, in the coming years and decades. And we just don't have the ability to balance a budget. We don't have the desire or the ability to have real, a positive interest rate. So real interest rates in positive territory. Just don't have that ability, because when you do that, your bubbles collapse. And then, of course, when your bubbles collapse, the banking system collapses. And if the banking system collapses, the Fed, that's what the Fed isn't there. That's what the Fed's there for. So why we have a Fed. So I don't anticipate any of this to change unless you had someone with someone who says, I am going to be president of the United States. We are going to have a depression, and we're going to wring out all the excesses. And it's going to be a terrible 2 or 3 years, like the banking crisis of 1907. And you know what? But we're going to have a real economy with a stable currency. And I don't mean stable coin, stable currency, and low taxes, low interest rates, low inflation, no asset bubbles. People can actually afford a house, a viable middle class. All those things can happen. But you're going to have to trust me. You're going to have to just, I don't know. It would be a brutal few years. Well, the market cap of equities is now over twice the level of GDP. That's something that hardly ever happens in history. In fact, it happened just after post-COVID time. But before that, you look at the average, it's like 100%, a little bit less than that. So why is the market trading at 2 times the GDP? I can only conclude we've had decades of falsified interest rates where real interest rates have been negative for most of the past 20 years. And that's also something that has never happened before. So you have a triumvirate of bubbles. And, yeah, I know I've been saying that they're going to crash. They've crashed before. It's not like they've never crashed before. They've crashed before. They're going to crash again. And getting the timing right is what my model is all about. Does it look like they're going to crash tomorrow? No, it doesn't, Kai. But if you look at the quiescence in credit spreads and you look at the quiescence in financial conditions, hey, this gambling carnival show is going to carry on for a little while longer, but it will end and it's going to be devastating. It is the most overvalued and most concentrated equity bubble in history. And you can add to that a credit bubble and you can add to that a real estate bubble. It has never happened before. We had three concurrent bubbles that are epic in proportion, and they'll pop and they'll be devastating. Getting the timing right and being able to short that is what Pento Portfolio Strategies is all about. So I voted for Donald Trump twice. So don't accuse me of being anti-Trump or anti-Republican. I'm actually a libertarian, so I'm further to the right than the Republicans. But the average revision under Donald Trump has been 77,000 jobs reduced. The average monthly reduction in 2025. So if this was some kind of conspiracy on the part of the Department of Labor and the Bureau of Labor Statistics, which is the division of the DOL, why report such strong numbers up front? And then when no one's really paying attention, revise them? That wouldn't make any sense to me. But yet we have an administration that's not only trying to, they blame this lady, Erica, who's the head of the BLS, that she's gone, she's fired because she deliberately, supposedly rigged the numbers. Listen, the numbers are horrible. The data calculation is abhorrent. The agency needs to be revamped and overhauled. But to claim that it's political against Republicans, I think, is ridiculous. And it's the exact opposite. So if you want to accuse the agency of doing anything, the Bureau of Labor Statistics, it's overstating job growth and then having to reveal the truth later in arrears. And if you look at the other target of the administration, which is the Federal Reserve, the problem with the Federal Reserve isn't that they keep interest rates too high perpetually. It's that they've manipulated them artificially too low for too long. And that is why we have such a tremendous bubble in the stock market and in the credit markets and in the real estate market. The salient issue here isn't that we have a Federal Reserve that's defended the value of the dollar and the middle class and the purchasing power of our currency. We have a situation in the United States now where 60% of the population has either no net worth or negative net worth. Little to no net worth or negative net worth. 60%. And that's because of the inflation, which is directly laid at the feet at our government. And now the problem is I'm supposed to, believe that we need to have Governor Waller come in May of 2026 and fix everything by slashing interest rates? Is that really the answer to rebuild the middle class of this country? Donald Trump did have a good idea. His idea on Liberation Day on April 2nd was to have these Liberation Day level of tariffs. If he stuck to that, we would have had a depression. But maybe at the end of that depression, hopefully a truncated one, we would have a healthy middle class and a revitalized renaissance in our manufacturing base. But what he's doing now with, the tariffs are 145%, then they're 35%, then they're 50%, and then they're double that if you buy oil from Russia. It's chaotic. It's causing a huge tax increase. I mean, someone's paying Trump's always bragging about all the money coming in. Well, who's paying that? It's the importing company pays it, and then the consumer pays it. If the revenue is coming into the government, then it's not being eaten by the exporters, the foreign exporters. So we have now a situation where most of the people in this country are hanging on by their nails, their teeth and nails, trying to stay afloat, trying to make ends meet. And on top of that, we have tariffs which really just went into effect today, Kai. This was the day that really most of the tariffs went into effect. So prices are going even higher for them. And what do they have to look forward to? More artificial manipulation of interest rates and more money printing and more inflation.
The U.S. stock market is currently so overvalued that MichaelPento says it would need to crash by approximately 50% to return to fair value. Pento lays out two scenarios. Either we get a long stretch where stock prices remain stagnant while GDP slowly catches up, or the gap closes rapidly in a brutal crash. Currently, valuations are significantly above economic output. According to Warren Buffett's famous indicator, this is the highest reading since records began in the 1970s, even higher than the 194% peak of late 2021, which came right before one of the sharpest U.S. stock market corrections in over a decade. Meanwhile, the U.S. government is already running $2 trillion annual deficits. At this pace, Pento warns, today's $37 trillion national debt could hit $67 trillion within a decade. And foreign buyers? They're stepping back from U.S. treasuries, leaving mostly speculative traders to hold the bag. A Reuters survey of bond strategists suggests longer-term treasury yields could rise modestly in the months ahead, driven by tariff-related inflation fears and the flood of new debt hitting the market, even as short-term yields drop on renewed expectations for Federal Reserve rate cuts. Let's get back to the interview.
I'm glad that that week between April 2nd and April 9th happened because so April 2nd was the announcement of Liberation Day tariffs, and April 9th was the effective date. And between then, the market lost, the S&P lost 15%. I mean, it was just, it just fell off a cliff. And the credit markets also started to freeze. So Trump says they were getting yippee or whatever is the words he used to describe the credit markets and the trading of treasuries in particular. So he had to reverse course. It just goes to underscore and illustrate very clearly how fragile this bubble is. He made a proclamation about tariffs, and before they even went into effect, the markets and the economy began to shut down. So, of course, it was easily ameliorated by him just reversing course and say, "Oops, I'm just joking. This is all a game. So it's all 4D chess. I didn't mean anything I said. So we'll suspend everything for 3 months, and we'll talk about it later." But it just goes to show you how fragile the system really is. And here's the salient concern that I have. Because I did say that the markets go. Well, here's what I'm saying. The market to reach fair value needs to drop by 50%. That's just fact. If you believe in reversion to the mean, history tells me that reversion to the mean always works, and nature hates vacuums, and nature seems to revert to the mean too. So it's just an immutable law. I mean, either the stock market goes nowhere for a decade and GDP and incomes catch up, or it crashes and the two kind of meet. One of those things is going to happen. You can't stay with this kind of market where you have the market here and GDP here. It just doesn't work. It just doesn't work that way. So eventually that's gonna mean revert. But what I'm most concerned about is come next year when we replace Powell with someone I call a obsequious sycophant who is just going to do the president's bidding, which really what banana republics do. Banana republics are highlighted by insolvent countries. Well, you could check that. That's a check. We check that box. Economic data that they report that you just can't trust because they just lie. Well, now we're being told that if you try to report the data accurately, even though your methodology is horrible and it needs to be overhauled, but if you try to do it correctly, but it makes the president look bad, you're fired. So I guess the replacement for Erica is going to be someone who's going to be very scared to report a bad number, right? Banana republics are marked by central bankers who just like do the head of state's bidding. Then you can check that box too. So my fear is that once all these things come in place and you have a central bank that's slashing interest rates on the short end, when inflation has been above the Fed's target for 50 months in a row, and it's rising further away from that target, and then you slash interest rates in the context of $2 trillion deficits, which are rising rapidly. We're gonna add another $30 trillion to the debt in the next decade, $67 trillion in debt. And at the same time, foreigners aren't borrowing our debt anymore because they don't have that trade surplus to recycle into our bond market. All you're left with is gamblers, and individual institutional investors aren't even very long this market. It's all the meme stock gamblers. Hey, you just buy Palantir and Nvidia and you can retire next year. I'm 62 now. Next month be 62. I've been doing this 35 freaking years, Kai. I've seen this before. I know how it ends. So I manage money for a living. We are net long, but I don't go off golfing every day and check my portfolio every month and then do some sales calls. I'm managing the money first, and then I'm trying to raise assets. They come naturally. I'm not a salesperson. You have to watch this thing very closely, because what happens next year if we slash interest rates and the long end of the bond market revolts, just like it did in 2024. The Fed cut interest rates by 100 basis points, and the long end said, we're not having it, right? So if the long end of the bond market becomes unmoored and that starts to spike, there's nothing. What's the Fed going to do? Cut rates even more and add more inflation to it? Maybe they can do some kind of operation twist, and they could, maybe buy the long end, try to cap it. But that would mean they have to even print more money, and the Fed's balance sheet has to go to, $20 trillion instead of stopping at 9 like it did last time. So the dollar is going to get wrecked, especially against hard assets. Inflation is going to soar. You're not going to fool the bond market. I mean, is the Fed going to assent to buy corporate bonds too? How about municipal bonds? How about junk bonds? How about private credit? I mean, where is it going to end? So something is going to have to give. And in that case, if the long end spikes, mortgage debt is priced off the long end, auto loans, student loans, and corporate bonds are priced off the long end of the bond market. So no matter what the Fed does, it could be an absolute unmitigated disaster for these bubbles if that happens. Now, am I predicting that? Am I etching that in stone? No. I'm not saying that's going to happen. I'm saying it's a salient risk. It's a significant risk. And if it happens, I will monitor it. I will act ex ante and make sure my clients are safe. But most individual investors will get wiped out, because you see how fast we live in a new world now, where, bids just hit a button, bids disappear, and, you're down circuit breakers on Wall Street. That's going to happen. You're going to hit the NYSE circuit breakers, down 7.5%, close for an hour, down 13%, close for the day. Something like that's going to happen. That's my fear. And I'm not trying to scare you. I mean, I'm just saying, listen, don't believe me. Believe Warren Buffett. He's a little smarter than I am, right? Warren Buffett has an indicator. It's called total market cap of equities to GDP. It's now 209%. And go back to see where it was go back in the NASDAQ bubble. It was only 140% before the NASDAQ lost 80% and the S&P lost 50%. Go back to the start of the great global financial crisis, where it was only 104% of GDP. Now it's 208% of GDP. This is in the thermosphere of valuations. That's not only that, Kai. It's the CAPE ratio. It's the price to sales ratio. It's the what's the other one I love to look at is equities as compared to the inverse of the PE ratio, which is the earnings yield, is now negative. So risk premiums are now negative. So you can get more out of owning a T-bill than you can on the earnings yield on stocks. The dividend yield on stocks is at a record low or very close to it. Don't believe me. Look at the data I just mentioned, verify it, and say, oh, this guy's got a good point. In fact, there was a guy on Bloomberg this morning who says, one of the nice interviewers said, it's kind of bubblicious out there. It's kind of frothy prices. What do you think? Oh, no, if you take out the tech stocks, which are, a separate issue, then the market's only trading at 20 times earnings. Well, let me see. So if you take out everything that's in a bubble, the market's still in a bubble, because 20 times earnings is still very rich valuations. And that means the market's going to crash. Taking out everything that's in a bubble, is that something you should really do? Listen, of course AI is real. Of course it's going to be a big productivity boost. But the same thing could be said for the internet in the year 2000. And I'm not saying the NASDAQ, because the construct of the market is better this time than it was 2000. So maybe not by 80% is it going to fall, but could it fall by 40 or 50%? Absolutely, no problem. And in a recession or a credit crisis, you will see it happen. You'll see it happen quickly. You better pay attention.
Runaway government spending, swelling interest costs, and inflated asset prices are converging into a financial setup that leaves little margin for error. Decades of relying on debt-fueled growth have built an economy where market valuations float far above productive output, and the gap shows no signs of narrowing through gradual means alone. With international creditors stepping back and speculative money propping up the treasury market, the stability of the current system grows increasingly fragile, while each new round of monetary easing adds fuel to the very imbalances policymakers claim to manage. Left unresolved, these forces could culminate in a sharp realignment, one that reshapes investment priorities, tests political resolve, and forces hard choices about what the nation can afford. The pressing question now is whether change will come through deliberate policy or be imposed suddenly by market realities. Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.